Wall Street is watching oil hover near $60 and calling it stable. But beneath that calm surface, 2 million barrels vanished in days. China quietly absorbed 13 million barrels per day in December alone. Building reserves, most analysts aren't even tracking. U.S. rig counts dropped to levels not seen in years, while decline rates accelerated. And silver? Trading like nothing's changed, even as industrial demand outpaces every supply model. The last time these signals aligned, the repricing was brutal, and it happened faster than anyone expected. What Wall Street is missing right now could redefine energy and metals markets for the next decade. Welcome to John Analyst, where we examine the markets Wall Street prefers you didn't understand. If you've built a career making decisions that matter, if you value analysis over noise, then this channel was created specifically for you. Consider subscribing, not because algorithms demand it, but because the next strategic shift won't announce itself with headlines. And tell us, where in the world are you watching this from today? Your perspective matters here. Now, let's examine what's actually happening beneath the surface. The energy sector has become financial pariah territory. Institutional allocators won't touch it. Ethical mandates exclude it. And retail investors remember the pain of the last downturn with enough clarity to simply walk away, which is precisely why what's happening right now deserves serious attention. Because when an entire asset class becomes untouchable, when consensus reaches levels of certainty that border on religious conviction, markets have a tendency to do something most participants never see coming. They reprice violently. Right now, crude oil trades near $60 per barrel. Brent hovers in the mid-60s. And financial media treats these numbers as evidence of oversupply and weakening demand. Surface level, that narrative holds. Dig one layer deeper, and the picture fractures completely. In recent weeks, winter weather systems knocked out approximately 2 million barrels per day of U.S. production, simultaneously disrupting refinery operations and stressing power infrastructure across multiple states. 2 million barrels. That's not a rounding error. That's roughly equivalent to removing a mid-sized OPEC member from global supply. And yet, prices dipped. Why? Because traders immediately shifted focus to other supply sources returning to market and began pricing in a near-term surplus narrative that assumes everything will simply balance out. But here's what that assumption ignores. The futures curve itself is telling a different story. When front-month crude contracts trade at a premium to later-dated contracts, a condition called backwardation, the market is effectively broadcasting an urgent message. Physical buyers need barrels now, not next quarter, not next year, now. That structure has appeared repeatedly in recent months, even while headline commentary discusses surplus conditions. This isn't contradiction, it's fragmentation. Paper markets, where traders exchange contracts and settle financially, can sell the macro story instantly, responding to spreadsheets, forecasts, and sentiment surveys. Physical markets move differently. They move on logistics, shipping schedules, refinery maintenance windows, and whether specific buyers actually need molecules delivered this week to keep operations running. When those two markets diverge, when the physical world tightens while the financial world prices in abundance, someone is wrong. And historically, the physical market doesn't lose those arguments. Now, layer in OPEC plus dynamics. Recent reporting indicates key producers are maintaining production discipline through March. With upcoming meetings, watch closely for any signals of policy shifts. This matters because it means global spare capacity, the cushion available when unexpected disruptions occur, remains constrained by choice, not by geology. OPEC Plus isn't flooding the market. They're managing supply carefully, watching inventory levels, and responding to price signals with restraint that wasn't present during previous cycles. Which brings us back to those weather-induced shutdowns. When extreme cold forces wellheads to freeze, when compressor stations lose power, when refineries trip offline due to feedstock interruptions, the damage doesn't simply reverse overnight. Production comes back slowly. Equipment requires inspection, systems need rebalancing, and in some cases, wells that freeze can suffer permanent productivity impairment. But here's the larger question that weather events expose. If a predictable winter storm can remove 2 million barrels per day for several days, what happens when something less predictable occurs? A geopolitical escalation in a critical shipping lane? An infrastructure failure at a major export terminal? Or simply the cumulative effect of years of underinvestment finally manifesting in production numbers that can't meet demand, regardless of price? These aren't hypothetical scenarios. They're the tail risks that energy markets pretend don't exist, until suddenly they do. And when they materialize, the repricings aren't gradual. The spot market doesn't send polite warnings. Prices gap, volatility spikes, and by the time consensus shifts to acknowledge the problem, the opportunity to position strategically has already closed. This is what makes energy markets so unforgiving. They punish early positioning, they punish late recognition, and they reward only those capable of reading signals that contradict prevailing narratives. Right now, those signals are present. Backwardation in futures curves despite bearish headlines, coordinated supply discipline from major producers, infrastructure vulnerability exposed by routine weather events, and underneath all of it, a simple mathematical reality that Wall Street's valuation models systematically ignore. Oil fields deplete every single day, existing production declines, and replacing that production requires capital, expertise, time, and increasingly, access to geology that's lower quality than what came before. Which raises the question no one's asking publicly. What happens when the world realizes it needs more barrels, and the industry that's supposed to provide them has spent years being told not to? That answer is what Part 2 examines. There's a number Wall Street doesn't talk about, not because it's secret, but because acknowledging it destroys the thesis that energy has limitless future supply. That number is the annual decline rate of existing oil fields, and it's accelerating. Think of it this way. Imagine owning an apartment building where 10% of your units become uninhabitable every year, not from neglect, but from physics. To maintain income, you'd need to constantly renovate or acquire new properties. Now imagine your bank cut your credit, and investors demanded you stop building and just return cash. How long before income collapses? That's global oil production right now. Existing wells lose output at a pace requiring 4 to 5 million barrels per day of new production annually. Just to stay flat, not grow, replace what's depleting. U.S. shale production hit 13.6 million barrels per day, and every analyst projects plateau, then decline if prices stay below $70, because shale isn't a conventional field, it's a treadmill. Average shale wells drop 60 to 70% in year one, then continue declining steeply. Maintaining output requires constant drilling, constant capital, and that capital is vanishing. U.S. rig count, mid-500s, oil-directed rigs in low 400s. The industry is drilling less, completing fewer wells, bringing less production online. But decline from existing wells doesn't stop. It doesn't care about capital discipline or ESG mandates. It continues. Now add this reality. The best rock has been drilled. Operators developed Tier 1 acreage first, the geological sweet spots delivering highest returns. What remains is Tier 2. Tier 3, rock that wasn't economic at $80 a decade ago. These wells underperform, require more capital per barrel, deplete faster. Some operators drill child wells near older parents, discovering interference effects, reducing productivity below expectations. The easy stuff is gone. What's left requires higher prices, better technology, more capital than markets will provide. Which brings us to the investment desert. For years, capital flowed into shale, funding growth at any cost. Then investors revolted, demanding free cash flow, buybacks, dividends, anything except drilling. Management teams slashed budgets, prioritized returns, and markets rewarded this discipline. But discipline has consequences. Underinvesting in depleting assets isn't conservative. It's liquidating the business in slow motion, paying today's dividend with tomorrow's production. Eventually, tomorrow arrives. Upstream capital expenditure stabilized around $500 billion globally, substantial until adjusted for inflation and real-world cost increases. In real terms, the industry invests less than a decade ago, while replacing production from fields that are older, more complex, depleting faster. The mathematics don't work. You cannot have accelerating decline rates, diminishing inventory, reduced capital, and stable supply. Something gives. Either prices rise enough to justify reinvestment, or production falls until demand adjusts through economic destruction. No third option exists. Here's the valuation paradox, creating opportunity. Wall Street models apply discount rates. Declaring cash flows beyond 7 years barely matter. A barrel in year 10 gets valued at a fraction of next year's barrel, even though both cost the same to extract and generate identical revenue. This makes sense for technology companies facing obsolescence. Makes no sense for oil and gas, where today's reserves remain valuable 20 years forward. But the sector gets painted as dying industry. So long-life assets trade at valuations ignoring duration entirely. Companies with 10, 15, 20 years of quality inventory get priced as if worthless by 2030. This creates setup. Because when markets realize demand isn't disappearing, replacement supply isn't materializing, and prices must rise substantially just to maintain flat production, those long-duration cash flows suddenly matter, and valuations don't adjust gradually. They gap. Multiple expansion occurs simultaneously with earnings growth. Operational leverage kicks in, and companies trading at 5 times cash flow suddenly deserve 12, but only if they maintained production capacity, only if they didn't liquidate inventory during lean years, only if they kept drilling, kept developing, kept investing when everyone else capitulated. That's why the companies Wall Street punished for maintaining capital discipline, for not maximizing buybacks, for keeping rig count steady. Those are the ones positioned for asymmetric returns, because they'll have barrels to sell when prices rise. They'll have inventory to develop when margins expand. They'll have operational leverage when the market finally reprices energy scarcity. And there's one more piece to this puzzle that almost nobody is tracking properly. While Western markets debate peak demand and energy transition timelines, while analysts build models assuming supply will always be available, and while investors systematically underweight the sector, one buyer has been quietly accumulating every spare barrel the market produces. China imported 13.18 million barrels per day in December, building strategic reserves, targeting 500 million barrels, absorbing surplus, stabilizing prices, and creating a floor most analysts don't recognize. But that support is conditional, price sensitive. When crude rises, that buyer disappears, and when that happens, the global balance shifts instantly. Which brings us to natural gas, where the infrastructure story is even more critical. There's a quiet war happening right now that most investors will never see. Not fought with weapons, but with molecules. Natural gas molecules, moving across oceans, linking markets that used to operate independently, and creating price transmission channels that didn't exist 5 years ago. And the infrastructure required to win this war doesn't exist yet, which means someone is going to be left without power when they need it most. Here's what changed. For decades, natural gas was a regional commodity. U.S. prices had nothing to do with European prices. Asian demand didn't affect North American supply. And if one region had surplus, another region's shortage was simply their problem. Not anymore. Liquefied natural gas terminals transformed the game entirely. When you can cool gas to negative 260 degrees Fahrenheit, compress it to 1/600th of its volume, load it onto specialized tankers, and ship it anywhere in the world. Suddenly, a cold snap in Germany affects drilling decisions in Pennsylvania. A heat wave in Tokyo changes export economics in Louisiana. And when Europe decides it needs record LNG imports, projected at 185 billion cubic meters this year, every molecule produced in North America becomes subject to competitive bidding. Think about what that means. U.S. natural gas used to be stranded, trapped behind lack of export infrastructure, trading at prices disconnected from global markets. Henry Hub could sit at $3 while Asian spot LNG traded at $15. That spread is closing, not completely. Shipping costs and terminal fees create arbitrage limits, but the linkage is real now, and it's accelerating. New export terminals are under construction across the Gulf Coast. Canada is developing its own LNG export capacity, and every molecule that leaves North America to serve international demand reduces supply available domestically, which creates a problem nobody's talking about publicly. The U.S. electric grid is already under strain, not theoretical future strain, current, measurable, documented strain. Summer peak loads are hitting records, winter demand spikes are stressing regional systems, and the infrastructure connecting generation to consumption was built for a world that doesn't exist anymore. Transmission lines designed in the 1970s, substations operating beyond planned lifespan, grid management systems trying to balance intermittent renewable generation with baseload demand. It's all held together with outdated infrastructure and real-time prayer. And now add this accelerant: artificial intelligence and data centers. The computational power required for modern AI models is staggering, measured in megawatts, not kilowatts. A single large-scale data center can consume as much electricity as a small city, and tech companies are building them everywhere, racing to deploy capacity before competitors, often in locations chosen for tax incentives or fiber connectivity, without asking whether the local grid can actually deliver the power required. Spoiler, many can't. Grid upgrades to handle this new demand are estimated to require trillions in investment, plural, over multiple decades. Trillions to build new transmission capacity, modernize distribution systems, and create the redundancy required for critical infrastructure. That work isn't happening fast enough, which means when demand spikes, something has to fill the gap immediately. Not next year, not after we build new nuclear plants, not once solar capacity doubles, right now. And the only generation source that can scale quickly, deploy flexibly, and provide reliable baseload or peaking power depending on need is natural gas. Coal plants are being retired faster than replacements come online. Nuclear takes 15 years from planning to operation. Renewables work beautifully until the wind stops or the sun sets. Gas is the bridge, except the bridge is getting crowded because simultaneously, natural gas is also feedstock for fertilizer production, petrochemical manufacturing, industrial heating processes, and residential consumption that spikes every winter. So you have competing demand vectors converging. Power generation needs increasing Industrial consumption steady, export commitments growing, and all of it drawing from the same molecule pool. This is why gas markets are so dangerous to trade and so lucrative to position for correctly. Because gas doesn't move gradually, it spikes, a polar vortex hits the Midwest, and prices can double overnight. A hurricane disrupts Gulf Coast production, and export terminals scramble for supply. A European cold spell coincides with low wind generation, and suddenly every LNG cargo in transit becomes subject to bidding wars. The volatility isn't a bug, it's the fundamental nature of a commodity where storage is limited, transportation is constrained, and demand is non-negotiable when grid stability is at stake. Now layer in the investment thesis, unlike oil, where demand faces legitimate long-term questions around vehicle electrification and efficiency improvements, gas demand has multiple durable drivers that aren't disappearing. Electricity generation isn't going backward. Data centers aren't getting demolished. Industrial processes still require feedstock, and the build-out of alternative baseload capacity takes decades. Even in the most aggressive energy transition scenarios, gas remains critical through 2040 at minimum, which means companies producing, transporting, or exporting natural gas aren't facing obsolescence. They're facing structural demand growth with infrastructure bottlenecks creating pricing power, but not all gas exposure is created equal. This is where investor sophistication separates returns. Pure producers give you commodity price leverage. Every dollar move in Henry Hub flows directly to margins, but you also absorb full volatility when prices collapse. Midstream pipeline companies operate toll road economics, contracted volumes regardless of commodity price, stable cash flows, lower volatility, but also limited upside when gas spikes. LNG exporters capture global pricing, benefit from international arbitrage, but face counterparty risk, geopolitical exposure, and capital intensity that requires careful balance sheet management. Each structure serves different portfolio objectives. The question isn't which is best. The question is what role gas exposure plays in your specific strategy. Income and stability, midstream infrastructure, commodity torque and upside optionality, producers with low-cost operations, global exposure and arbitrage capture, integrated LNG players. And then there's the forgotten opportunity that most U.S. investors ignore completely. Canada, world-class gas resources, trading at structural discounts, because egress constraints and political uncertainty create a perception moat around the entire sector. But infrastructure changes everything. When LNG Canada reaches full operational capacity, when additional export terminals move through permitting, when pipeline constraints ease, those discounts can evaporate rapidly. Canadian producers with high-quality assets, conservative balance sheets, and exposure to improving export infrastructure represent asymmetric risk-reward. Because you're not betting on the resource, that's proven. You're betting on the market, finally pricing in access to premium international buyers. But here's where the entire energy thesis, oil and gas combined, connects to something most investors view as completely separate. Industrial metals, specifically silver, because silver's market structure exhibits the exact same dynamics currently playing out in energy. Systematic underinvestment, accelerating demand from new applications, and equity markets valuing long-duration cash flows as if they're worthless. The parallel isn't coincidental. It's the same market psychology, applied to different assets, creating identical mispricings. Wall Street makes the same mistake repeatedly, not because analysts are incompetent, but because institutional memory resets every cycle. They see commodity X trading at depressed prices, conclude it's abundant, and build models assuming supply will always be available at reasonable cost. Then, years later, they act shocked when supply doesn't materialize and prices explode. It happened with oil in the 2000s. It happened with copper during the China infrastructure boom. It happened with uranium when nuclear sentiment reversed. And it's happening right now with silver. Except this time, the supply deficit isn't coming from a single demand source. It's coming from everywhere simultaneously. Start with the obvious application everyone discusses: solar panels. Photovoltaic cells require silver paste for electrical conductivity, approximately 20 grams per panel in current generation technology. As solar deployment accelerates globally, each installation pulls physical silver from available supply. China alone installed over 200 gigawatts of solar capacity recently, with projections for continued aggressive expansion. Europe is rebuilding energy independence around renewables following geopolitical disruptions. The U.S. Inflation Reduction Act created incentives for domestic solar manufacturing and installation. Every single panel requires silver, not wants it, requires it. There's no substitute that matches silver's conductivity and reliability at scale. Manufacturers are working on thrifting technology, reducing silver content per panel, but deployment growth is outpacing those efficiency gains. Net result, solar installations are consuming more silver annually than the market anticipated even 3 years ago. but solar is just one vector. Electric vehicles use significantly more silver than internal combustion vehicles. Not slightly more, multiples more. EVs require silver for battery connections, power electronics, charging systems, and electrical contacts throughout the vehicle architecture. As global EV adoption accelerates, regardless of pace debates, each vehicle produced represents incremental silver demand that was not present in the legacy automotive fleet. Then add 5G infrastructure, which requires silver for components and connections throughout network build-out. Add medical applications, where silver's antimicrobial properties make it irreplaceable in wound care and certain devices. Add electronics miniaturization, where smaller components actually require higher silver content per unit to maintain conductivity. Every demand vector is pointing the same direction. Up, now flip to supply, where the picture becomes genuinely concerning. Approximately 70% of silver production is byproduct, meaning it comes from mines, primarily extracting copper, lead, zinc, or gold. Silver isn't the economic driver, it's the secondary output, which creates a bizarre dynamic. When copper prices fall, mines reduce output or shut down in silver supply contracts, regardless of silver's price. Primary silver mines, those specifically targeting silver deposits, represent only 30% of global supply, and those operations face the same challenges plaguing all mining. Declining ore grades, meaning you process more rock for less metal. Extended permitting timelines, especially in developed jurisdictions where environmental review can take years. Capital intensity, where building a new mine requires hundreds of millions up front before producing first ounce. And expertise scarcity. Experienced mining engineers and geologists are aging out of the workforce faster than replacements arrive. The result, even when silver prices rise, supply doesn't respond quickly. New mines take 7 to 10 years from discovery to production. Existing mines are depleting high-grade zones. Byproduct supply depends on other metals economics. And recycling, the market's supposed safety valve, is price-sensitive but ultimately limited. You can recover silver from electronics and photography, but those flows are already optimized. There's no massive hidden recycling reservoir waiting to flood the market. So demand is accelerating from multiple durable sources, and supply is constrained by structural factors that money alone can't solve quickly. That's the setup. But here's where it gets interesting for equity investors. Silver mining stocks are priced for historical ranges. Most equity valuations embed assumptions of $20 to $25 silver, sometimes lower. Analyst models discount future cash flows aggressively. Applying rates that essentially declare production beyond year 7 barely matters, just like energy companies. Same psychological bias, different commodity. But when spot silver prices exceed the embedded assumptions in equity models, something powerful happens. Operational leverage. A silver miner with all-in sustaining costs around $15 breaks even modestly at $20 silver. But at $30 silver, they're not making 50% more per ounce. They're making multiples more, because most costs are fixed or semi-fixed. Labor, equipment, processing, administration. These don't scale linearly with price, so margins expand faster than price movements. A miner earning $2 per ounce margin at $22 silver might earn $12 per ounce at $32. That's not 50% margin expansion. That's 600%. And when markets finally recognize that cash flow explosion, they don't just reprice earnings, they reprice multiples simultaneously. The stock that traded at 6 times cash flow suddenly deserves 14. Earnings multiply, valuation multiples expand, and equity returns can be violent. But only for companies that maintained production capacity. Only for operators that kept developing reserves during lean years. Only for management teams that didn't liquidate the business to appease short-term shareholders. This is the exact parallel to energy. In both sectors, Wall Street is systematically undervaluing long-duration assets, applying discount rates that ignore the tail, and pricing companies as if commodity prices will remain depressed indefinitely. When that assumption breaks, the repricing isn't gradual, it's asymmetric. Now here's the strategic framework that ties everything together. Energy, metals, commodities broadly, they aren't story investments. They're timing and positioning exercises. The fundamentals can be perfect. Supply deficits real, demand durable, and prices can still languish for months or years, punishing early positioning, exhausting conviction, shaking out weak hands before the move finally materializes, which is why investment approach matters more than asset selection. 3 principles separate those who survive cycles from those who capitulate. First, balance sheet fortress. Companies must survive extended downturns without diluting equity or defaulting on debt. Conservative leverage, adequate liquidity, manageable refinancing schedules, because the best opportunities often appear when macro conditions are ugliest, and only the survivors can capitalize. Second, operational quality. Low-cost production. Tier 1 assets. Management teams with capital discipline and shareholder alignment. Not the loudest story, not the most aggressive growth promises. The boring companies that execute consistently through cycles. Third, duration and patience. Commodity investments require time horizons measured in years, not quarters. Volatility will be extreme, drawdowns inevitable, and headlines relentlessly negative during accumulation phases. Investors who can't endure 30 to 40% temporary declines, who panic during sector pessimism, who need immediate validation, should not touch this asset class. But for those capable of maintaining conviction through volatility, the current setup across energy and metals offers something rare. Multiple sectors exhibiting similar characteristics simultaneously. Structural supply constraints from years of underinvestment, accelerating demand from durable sources resistant to economic cycles, equity valuations that ignore long-duration cash flows, and market psychology so bearish that positioning contrary to consensus feels uncomfortable, which is usually the signal that risk-reward has turned favorable. The repricing won't announce itself with headlines. It will happen suddenly, violently, and by the time consensus recognizes the shift, the asymmetric returns will have already been captured by those who positioned early. This isn't prediction, it's probability. And in markets, understanding probability distributions matters far more than guessing exact outcomes. The question isn't whether oil hits 90 before 50 or whether silver reaches 40. The question is whether current prices adequately compensate for the range of possible outcomes. Right now, across energy and industrial metals, they don't, which creates the unique opportunity referenced in the title, not because it's guaranteed, but because the market is offering asymmetric payoffs to those willing to position before consensus shifts. That window won't remain open indefinitely. It never does.